Hello, and welcome to Eris for Developers, blockchain savvy, distilled and concentrated. I am Meher from Validity Labs. This short 13-minute video is an excerpt from our 2-day workshop covering the Eris technology stack. In this section, I present to workshop participants what mortgage-backed securities are and how we can build this financial instrument using smart contracts. Let's begin. In this section, I shall introduce the advanced workshop example of mortgage-backed securities built using an ecosystem-centric process management system. We shall strive to implement parts of this example later, so please pay attention to this section. We, the course creators, are motivated to present this example in order to convey the long-term potential of blockchain technology. No claims are being made about short-term business opportunities in the real estate financial sector through this example. The next few slides will walk through basic know-how about mortgage-backed securities, a financial construct used to match investors looking to make a return with homeowners that need loans. Mortgage-backed securities are created with the concerted effort of mortgage originators that make loans to homeowners, servicing companies that make sure mortgage repayments happen on time, investment banks that purchase mortgage obligations and create special purpose vehicles to manage cash flows, ratings agencies to rate quality of mortgage-backed securities, and other players. Therefore, this is a large, complex ecosystem with many players. Total outstanding mortgage-backed securities typically number in the trillions of dollars as indicated from this US-centric data point, excerpted from the Securities Industry and Financial Markets Association statistical release. We start with a basic mortgage as described in the previous talk. A mortgage originator loans a home buyer a large principal in exchange for an obligation from the home buyer to make monthly principal and interest payments. In our example, the principal amount is $1 million and the monthly payments are $4,500 per month, calculated from an interest rate of 3.5% per annum. In case homeowner defaults, the mortgage originator can claim the mortgaged home, sell it off, and recover part of the principal amount. This slide presents some examples of mortgage origination companies from the US, Hong Kong, and England. At the ecosystem level, we deal not with a single mortgage, but with thousands of mortgages made by different companies to homeowners across multiple countries. In this slide, we diagram one single mortgage originator that might have made 1,000 mortgages, each yielding $4,500 per month in payments. We can visualize each of these mortgages as being a stream of cash flows from individual homeowners to the mortgage originator. Please bear in mind that not all mortgages pay off $4,500 a month. This is just an assumption to make the mathematics easier and aid with comprehension. In the second step, the mortgage originator sells its claim to all of these 1,000 cash flows to an investment bank such as JP Morgan Chase, Fannie Mae, or Deutsche Bank. In exchange, it might receive $1.1 billion, a sum of money enough for it to recover back all the capital it spent in making the mortgages and to make some profits on its mortgage creation activity. As this sale frees up capital from the balance sheet of the mortgage originator, it is free to use the proceeds to make mortgages in the market. After this step, we have the homeowners paying the monthly payments and these being routed to the investment bank. Now the investment bank does something very special. It creates a new corporation, christened Special Purpose Vehicle, as a new house for claims over all of these cash flows. The investment bank now transfers claim over all the 1,000 mortgage cash flows to the special purpose vehicle and sells shares in the special purpose vehicle to the market. Players in the markets such as individual investors, hedge funds, institutional investors, and pension funds buy these shares. These shares entitle the investors to receive fractional claim over the value that flows monthly to the special purpose vehicle, hereafter called SPV. The money raised by selling the shares is used to compensate the investment bank for the money it spent in acquiring rights over cash flows in the mortgages, plus a portion in revenue for the underlying service of creating the SPV and bundling the mortgages. In our example, we started with 1,000 mortgages, each yielding $4,500 per month for a total cash flow of $4.5 million per month, in the scenario where none of the homeowners delay payments or default on their obligations. Also, we assume that the SPV has 1 million shares and therefore holding each share entitles the holder to $4.5 per share per month in cash flows received from homeowners. These shares in the SPV are called mortgage backed securities. They are securities that derive their worth by being fractional claims over the rights of a group of mortgages. This example might seem complex, but the underlying idea is simple. What is taking place is the exchange of promises made by homeowners in return for money. At the top, each of the 1,000 homeowners initially promised to pay the mortgage originator a certain amount of money per month. The mortgage originator sells these promises to the investment bank, which further sells it to the SPV. Shares in the SPV represent a promise by the SPV to forward its investors at the bottom cash flows received every month as dividends. At the end of this process, the flow of money looks something like this. At the top are homeowners and at the bottom are investors. The SPV is a conduit through which the opposite needs of homeowners and investors are matched together. Mortgage-backed securities, originally conceived in the 1930s, were a huge financial invention as they freed up capital inside banks and mortgage companies to make new loans, created a new class of security for return-seeking investors globally, and diversified risk of defaults for investors by providing them exposure to a basket or package of mortgages. All these properties led to huge growth in the sector from the 1990s onwards. Finally, it serves to bear in mind that the past few slides with their rounded off numbers represent a simplified model. The actual market has much more complexity with items such as bundling together of mortgages that pay different amounts in payments every month, handling prepayment risk, that is the risk that some owner will pay the principal amount down faster than anticipated, handling the risk of a fraction of homeowners defaulting on their obligations, debt collection agencies, which are ecosystem players that become active in cases of default, ratings agencies, which assess the creditworthiness of homeowners and assign ratings to the mortgage-backed securities, and finally, more complex financial constructs like collateralized debt obligations built of a similar concept. We will ignore some of these complexities in the workshop in order to keep the example tractable. This workshop will have us attempt to build the structure represented on this slide. The SPV is replaced by a pair of smart contracts that are tasked with collecting monthly payments from multiple disk mortgages and forward this flow of money to a set of investors. Each homeowner shall pay monthly payments into disk mortgages as discussed in the previous talk. This kind of structure can represent wholesale financial automation in the real estate finance industry. We shall start off from this point in our advanced example hands-on programming session tomorrow. For a moment, take a leap of faith and imagine all of it possible. We can use smart contracts as disk mortgages, smart contracts as special purpose vehicles, and all of this running on a blockchain jointly maintained by different ecosystem players in the industry. Players such as mortgage originators, investment banks, and regulators. That would mean we have built a shared IT system across multiple organizations that serves a purpose of mediating the relationship between homeowners and investors through the use of smart contract applications. This is, in our opinion, an ecosystem application running on ecosystem-centric IT tooling. The tooling also mediates the business relationship between pairs of ecosystem players such as mortgage originators and investment banks. For an analogy of what we are about to build, consider the plumbing system of a city such as Zurich. In essence, the plumbing system connects sources of water supply such as rivers, dams, and wells to sources of usage or drain such as faucets, water parks, and public fountains through a complex circuit consisting of pipes, pumps, valves, and junctions. Now in this image, start to replace sources of water supply with sources of continuous money supply in our example, the homeowner making monthly payments. Replace the sinks of water supply with sinks of money supply in our example, the investors getting paid monthly dividends. Replace water with money. Finally, replace the plumbing circuit, pipes, pumps, etc. with smart contract components such as the disk mortgage. Do you see the analogy? Isn't it a beautiful one? Just as hydraulics is the control over the flow of water and electronics the control over the flow of electrons, we are dealing with control systems regulating the flow of money. It's a very big deal. Let us return to some of the trade-offs alluded to earlier. While blockchains can empower businesses to compete by forging ecosystems to shared systems, they have particular downsides as well today. The most important is privacy. Whatever goes on a shared blockchain is visible to all ecosystem participants, some of whom might be future competitors. Therefore, as engineers, we need to design systems which expose as little business critical data as possible while reaping the benefits of this technology. There are many methods available to system designers for keeping enterprise data private in an ecosystem-centric setting. The second is current blockchain designs have maximum processing rates of several thousand transactions per second, and latency time, defined as the time from submission of a transaction to its confirmation, of several seconds. All designs must operate within this technological capability. That brings us to the end of this short video excerpt. This excerpt is part of the 2-day workshop Eris for Developers designed and hosted by Validity Labs. The workshop is also officially endorsed by Eris Industries. Thank you for taking out the time to check out the video. Do drop us a note at the indicated touch points if this workshop is of interest to you. Thank you and talk to you soon.